My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain you, but to educate and teach you. Put it in context. Call me, 1-800-743-CNBC. Tweet me, @Jim Cramer. All right, how can this market snap out of that bizarre malaise where the reopening stocks keep roaring and everything else, especially tech and healthcare, gets left behind? After the day where the Dow declined 104 points, S&P dipped 0.32%, and the Nasdaq actually did a little bit better, edged down 0.11%, but it's still headed for its worst month since October. Let me tell you what needs to happen. I've got the solution, all right? And it's a little complex, but I'll give it to you. First, there is way too much speculation in this market. We're still seeing lots of money pouring into areas that are very hard to value. Just look at the crawl at the bottom. I mean, you see this right down here. I mean, see right below me, okay? Look at this. I'm not saying those companies are worthless, but the amount of volume that changes hands every day in that low dollar stock and that low dollar stock and that low dollar stock, that should make you, look at that one, should make you very nervous. It's a sign of excessive speculation. With inflation, these are the moral equivalent of penny stocks, for heaven's sake. Second, too much greed. Yeah, one look at the newly launched Ark Space Exploration ETF tells you everything you need to know about how managers can't resist creating new funds, even if there's no reason for them to exist. They love to create ETFs. They love to advertise ETFs. Now, look, sure, this fund has some quality companies that can pass as space plays. They've got Trimble, Kratos Defense, L3Harris. Though something like L3 is mainly a high defense contractor. We have them on. You got Lockheed Martin and Boeing, which do have some space exposure, even if it's not their main business. The thing is, this fund also includes Amazon, Alphabet, and Netflix, along with some Chinese e-commerce plays like JD.com, Alibaba, Tencent. Deere's in there, too. Yeah, Deere, the tractor company. It's ridiculous. But there aren't enough genuine space-related stocks to make a decent ETF, and the manager wants to collect that 0.75% expense ratio. Maybe, I have an idea. Don't launch a space ETF if you have to pad it out with Netflix and Deere. You know what? I was surprised that GameStop isn't in it, because GameStop is synonymous with rocket ships over at Wall Street Bets. YOLO. It's not just Ark. Look, at the ridiculous amount of risk the banks expose themselves to with this Archegos hedge fund, you know what that's about? That's about greed. The industry might have lost $10 billion here, and we know they were avoidable. Why? Because this fund did not ensnare everybody. J.P. Morgan considered working with them and passed. They exercised something I've been searching for this word all day because it's not really available anymore on Wall Street. Judgment. Something that is in very short supply. And they decided this fund wasn't worth the risk. They didn't trust Archegos. They didn't trust it. Everyone else chased those commissions, with Nomura and Credit Suisse getting hit particularly hard because they were so desperate to show that they're the go-to banks for hedge funds that need absurd amounts of leverage. Sold to you. Or how about the endless SPAC attacks? I mean, so many of these are basically blank checks for people well, I wouldn't trust with the money in my wallet, let alone hundreds of millions of dollars of your money. I'm increasingly convinced that these SPAC mergers are just a way for startups to come public without any scrutiny from the SEC. In a real IPO, you can't make aggressive projections about how much you'll earn in 2030. I think we're going to need to regulate these deals the same way. SEC memo. Start focusing and regulating SPACs the way you would an IPO. Just go do it. Just find a way. Just use the 34 Act, for heaven's sake. Anyway, worst of all, you've got these NFTs, or non-fungible tokens. Now, these are supposedly unique digital items, although I'm not clear on what makes them unique other than a digital ledger. Are NFTs a scam? Let's just say there's a little too much of the old P.T. Barnum involved here. Maybe I'm missing something and they go up in value, but you should never buy something you don't understand. And I'm not seeing many people who can explain the value proposition here. Third thing that needs to change, too much stock supply. Went over this again last night, not enough demand. Wall Street syndicate desks are so eager to make money that they keep printing stocks, flooding the market with newly minted IPOs and secondary offerings and SPACs. They'll put their names on anything. Shameless. We need to digest the deals they've already thrown at us. The stocks that are sagging right now are sagging in part because investors need to sell their existing merchandise to buy this new stuff. Unfortunately, the brokers aren't creating stocks that participate in the great reopening trade. There's a genuine scarcity to those. Instead, they're hitting us with more of the same kind of software as a service, crypto, gaming, fintech. Yes, that are often very low quality. We don't need them. We don't want them. but nobody will exercise the discipline to stop the deals. Until the IPO spigot closes, these groups that we're stuck with are hammering everything else. Fourth, I'm beginning to wonder if the people who own the highest growth stocks actually know what these companies do. Can the owners of JFrog explain what the company does? Tadpole's TAM? How about Datadog? Chewy derivative? MongoDB? Do you know how Snowflake makes its money or loses its money? Splunk? Cave exploration company? Can you tell me the difference between Wix and Wex? How about Fiverr and F5? Slap me Fiverr. Is this the moment when you want to be in Bill.com or William.com? Is it time to buy HubSpot? See HubSpot run? Many people bought these stocks for one reason. They were going higher. Now that they're going lower, those shareholders don't know what to do. We saw the same thing happen in 2000. Eventually, the bull. Unfortunately, they tend to bull at the bottom. 5, we need to get rid of many of these companies. Now, the best way to get that to happen is mergers, where the smaller players consolidate the larger ones. The worst way is for them to run out of money and go under. I know this sounds extreme, but it's something that helped us escape from the IPO glut in 2000. This is what, I mean, in 2016. They need this.
Merger.
This is what you need. Thank you. Okay.
Merger.
Finally, we can use some signs that inflation is cooling. The bond market says it's not, which is why rates keep rising. But if oil prices were to come down and we get a deal with Canada on lumber and the petrochemical plants along the Gulf restart and the semiconductor companies in Asia expand production, then it could happen a lot faster than we think. Remember, inflation is devastating to high-flying growth stocks like the ones that keep going lower because they're all about the potential earnings many years down the road, and inflation erodes the value of those future dollars. It's no coincidence that these stocks started rolling over right when rates began to surge. Now, I know this is a tall order to eliminate all these problems that are plaguing the market. They have their own momentum, and it's not like there's some grand inquisitor out there who can make Wall Street less greedy. I know Congress has its preoccupations when it comes to the financial industry, but they're more worried about the gamification of GameStop than the SPAC attack or the endless proliferation or of rogue hedge funds. I think they should be less worried about what regular investors are up to on Reddit and more worried about over-levered hedge funds and what they're doing to Wall Street. Unfortunately, and what Wall Street's doing to them. Unfortunately, there's no off switch for this stuff. We just have to let these issues play out. The SPACs and the IPOs will stop once the brokers see that these deals keep losing people money. They do care about their customers eventually. The high growth shareholders will eventually get blown out if they own stocks that they don't understand. But until then, we've got to work our way through a difficult situation. The bottom line, there is a solution. You can stick with the boring oil companies that are doing incredibly well right now thanks to low rates and a huge stimulus package, the ones that are delivering much better than expected earnings and buying back stock, not issuing them. Or, other than that, you're going to be in siege mode. Because that's what this is, a siege. And the siege for this group could last a lot longer than people expect.
Don't miss a second of Mad Money. Follow @JimCramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.